Joining us here on set this morning, Adam Parker, of course, Trivariate Research CEO and a CNBC contributor. Great to have you, AP.
Always good to be here.
You wrote about September, which does have the lowest average return, right?
Yes.
But you say you don't see signs that it's significantly a bad month.
Well, I was being, geeky and statistical significant there. It's the worst return with above average volatility. I think, as we've been highlighting the last few weeks, I think conditions are deteriorating. I'm not surprised. We've been talking about, I guess Dollar Tree, you take out the word tree, put in the word general. I mean, every week, you're sort of surprised something's down 20 when the other thing was down 20 last week. The consumer's slowing. It's been happening since mid-July. You've seen it across housing, autos, low-end consumer, Visa. I mean, I don't know how that's surprising. I think the incongruity that I see that's making me a little bit more cautious on equities and risk-taking is just simply that earnings estimates have not come down at all, particularly for Q4 in 2025, yet everyone expects the Fed to start a long, 8-cut path for the next year. So something has to give. Either the economy is a little bit better, it is a soft landing without a growth scare, and equities are great, or the earnings numbers have to come down more than they normally have to come down. And so that, I think, is where the tension is sort of lying. And the estimates are high.
I mean, I see that, although I think that it's up for debate as to whether the stock market at this exact level is based on a premise of 200 basis points of cuts, right? It's based on the direction of travel is easing because inflation's taken care of. It's not clear to me that if we say stocks price out 100 basis points of those cuts right now, where we necessarily fall.
My reaction to that is that I don't know.
Yeah, nobody.
But I know the market is ahead of the Fed.
Right.
That I could say I'm pretty confident in.
The bond market is absolutely ahead of
Your comment was exactly why equities ripped in January of 23, because we knew we were kind of close to done hiking, and then eventually we would dream of accommodation someday. I think the reason it's tricky, and when I talk to institutional investors all day, it's because the last few times we've gotten the Fed to cut, it came with other goodies, fiscal stimulus, balance sheet expansion, and all of us, our era, have learned don't fight the Fed. You're an idiot if you fight the Fed. Well, this time maybe you do, because the market's really far ahead, and I'm not getting all that balance sheet expansion and incremental fiscal at the same time.
Well, we learned don't fight the Fed as a phrase,
right? But
in reality, people are saying, the first Fed rate cut, maybe you sell, because look at 08 and look at 2000, right?
So I don't think the economy is going to deteriorate at the rate that requires 8 cuts, and then also not see a growth scare to earnings that's a little bit more than we're afraid right now. I think that's why I'm highlighting. So I do think the defense stuff makes sense. If I want to get super excited about anything, I think we talked about it a couple weeks ago when I was on, it's probably healthcare. I know it's acting defensive here, the services and other stuff, but I think it could also act as offense in the next upcycle, just in terms of the ability to improve the healthcare system through technology.
We're glued to NVIDIA, and it has actually turned around and is now up a third of 1%. It's significant, because it's so large. Right, at 2 point, where are we, 6 trillion or something? Yeah. Market cap. And also so indicative of the mood around AI and Gen AI and what that's going to do to our future. At 107, it's still up 117% year to date, but has had a sizable correction. I know you're a strategist, but do you have to have a view on this stock to have a view on the market?
Well, I used to cover semiconductors for a long time. That's when we met years ago. I think you have to have.
So what is your view on it?
I think you have to have context, right? I mean, the stock was $14 only 20 months ago, right? So the way I'm looking at AI semis is it's a giant party, and giant parties have huge hangovers, but the question is it still worth going to the party? Yeah, it is. Okay, it's going to be a hangover, but if you bought this thing in the $30 or $40, $50 range, you're still quite happy to have doubled. Okay, so it was a great party, right? And is the trend of AI semiconductors over? Of course not. We're going to be way higher on this stock in 3 to 5 years than we are now. We're in a kind of cooling off period. Margins at peak. Every time a company gets too big, the DOJ investigate. I mean, you have all that kind of stuff that happens every time. But if you're asking, is the general kind of trend of compute, all that comes with it, slowing materially? No, it is not. Right, so I think you still want exposure, and if you're a growth manager, what are you supposed to do? Say, hey, I'm running your money for you, Sarah, but I don't believe in the AI semiconductor trend, so I have no weight in semis? Of course not.